Okay, in this final video on investment information and securities transactions, let's take another peek at transactions and talk about some strategies with respect to how we make transactions. So we obviously need to open an account, and you can have either a single account or a joint account. Again, obviously, husbands and wives typically will have joint accounts. Custodial accounts are important if there is a minor involved, so that the parent or a guardian will have control over the minor's account. And of course, you can have a cash or a margin account. Now, there are also accounts called wrap accounts, and essentially what this does, it allows brokerage with customers to have large portfolios to shift their decisions, right, to a money manager. So essentially, you're going to give the money manager the right to manage your portfolio, and instead of paying commissions, what you will do is you will do that for a flat annual fee. So again, it's just a type of an account where we give somebody else control, but we also have some controls over the trades that they make and the frequency of those trades. Most stock transactions are made in what's referred to as a round lot. A round lot is 100 shares. And an odd lot is anything that is a function that's not a multiple of 100. Now, the reason why this is important is let's assume you want to buy stock from a company and you want to buy 5 shares. Now, that company, that brokerage house, doesn't have any of that stock in inventory, so they can't give you 5 shares from their inventory, if you will. So they're going to have to go out and get the stock to sell to you. Now, in the investments world, between institutions, everything is traded in 100 share units. So they're going to have to buy 100 shares to give you 5 shares. And that's going to make your transaction more expensive. Because now what are they going to do with 95 shares? It's an odd number, right? So again, most things are always bought in round lots. Odd lots are more expensive. Now, there's 2 basic kinds of orders. You can make what's referred to as a market order or a limit order. A market order either buys and sells at the best price right now. So it's the quickest way to fill an order. Now, there will be times where we'll want to be more specific about when a trade occurs. So this is what's referred to as a limit order. You're going to tell somebody to buy the stock at or below a certain price, or sell it at or above another price. So you're going to tell them, look, I want you to go. If this is the price, I want you to buy it. If that's not the price, I want you to wait. How long do they wait? And that's what the rest of this, you can have something that's referred to as a fill or kill order. Either they buy all the shares or complete the whole order, or it's canceled. You can have a day order. If it doesn't get closed by the end of the day, it cancels. And a good till canceled order. Typically, this is going to remain in effect for some time. Could be 6 months. It could be less than that. It could be stated how long you want that to stand and hold open. But at the end of the time frame, it's either executed or it's canceled, or it could be renewed sometime in between. So what is a stop loss order? A stop loss order is a suspended order, right? It's placed to sell a stock if the price reaches or falls below a specified level. And again, we can specify the day, how long it's open. Essentially what happens is once these things become activated, it becomes a market order. So it will actually happen as soon as the price or this trigger point is met. And this is the best way to protect against some adverse effects of rapid price decline, right? A limit order is an order to buy or sell stock at a given or better price once a stipulated stop price has been met. This again prevents the sale of something at an undesirable price, right? So no sale might occur if the price continues to decline. So again, these are ways that we can protect some of our trades. For instance, what if it was a short sale? We don't want it to sell if the price is going down. So again, we can specify how we want the orders actually to be closed. Other kinds of transactions, I'm sure you've heard the phrase of day trading, right? Day trading is when people buy and sell stocks. They do it all throughout the day. They do it very quickly. It's highly risky, especially if they're using margin transaction. There's a very high brokerage commissions. And since everything is being bought and sold on a daily basis, all of the taxation is at the day traders' marginal tax rate. So the taxes could be very high. One of the challenges we have with online stuff is, what about technology, right? What if services break down, right? What if there's a long wait time, right? So again, we have to worry about technology. We have to worry about our orders going through the way we want them to go through. So if you're doing online trading, I mean, what things do you want to make sure happens, right? You need to know how to place and confirm your order, right? Don't go on blind and try to figure out, I'll just do this and I'll figure out what happens. You need to understand the process. You need to verify the symbol that you want to buy. You want to use limit orders, right? You want to protect yourself if prices move in the wrong direction, right? Don't get carried away, right? Have a strategy, stick to it, right? Avoid any kind of impulse trading. And again, you might want to open accounts with a couple of brokers. And of course, you want to double check for accuracy when you're making trades. So what are the costs, right? Sometimes there will be fixed commissions, right? If you watch TV, you'll see frequently, $4.99 you can make a trade. Well, that's true, but how many stocks do you buy? If you buy 10 stocks at $4.99, that means you're spending 50 cents a stock to buy. For 100 lot, right, that's a nickel a share, right? But think about this. If it's $100 stock and you have to buy 100, right, that means that is $10,000. So on that $10,000, you're only paying a nickel per share to buy them. However, you got to have $10,000. Well, with margin, you have to have $5,000. You still have to have the money to make those kinds of trades. Now, there is something that's very similar to the banking industry, where the banking industry has the FDIC, which is insures against banks going belly up. There's the SIPC. And again, this insures a customer's account for up to $500,000 in securities and $250,000 in cash. Now, it doesn't guarantee you're going to get the dollar value of the securities, only that the securities themselves will be returned, right? So basically, this is just an insurance against a brokerage firm going belly up. So what happens if there are disputes in the investments world? Well, when you sign an account, typically what you also sign, there's a checkbox. There's a sign that says that you will not sue them for mistakes that are made, right? So what will happen is, instead of suing them, you will go to mediation, right? So this will be an informal kind of dispute process. It's non-binding, right? If you don't agree with it, etc. But if you get past the mediation thing and say you disagree, say, no, they're wrong, I think this is the way it should be, then you could go one step further and go to arbitration. And arbitration has a binding agreement. So everybody that goes there realizes that once you're done there, you're done. And this keeps us out of the court system with bickering about unhappy customers and mistakes that might be made that can be rectified fairly easily with just some arbitration. The last couple things we want to talk about are what are referred to as, we know what investment advisors are, but we also want to talk a little bit about what an investment club is, right? An investment advisor is a person, right? It's an individual firm that provides advice, typically, obviously, for a fee. And investment clubs are partnerships of individuals coming together. The basic idea is they're going to invest their money. So they'll have committees and they will decide where they're going to invest their money. So we've talked about this earlier. We know that investment advisors are regulated, right? So there was the Investment Advisors Act of 1940. This ensures the backgrounds, disclosure, etc., right? All advisors are required to be registered and file reports, right? Typically, you want to look for advisors with some professional designations. CFA, CFP, all right, CHFC, those are the primary investment types of certifications. The others are more accounting kinds of designations or insurance designations. Obviously, we need to understand something about the cost of using investment advice, right? What does it cost? Typically, professional investment advice for small portfolios, somewhere between 2 to 3% of the funds under management. And again, that is on top of whatever the transaction fees are. So you want to look for low fees, low investment advice fees, but you also want to find out if the people know what they're doing. You want to look for good performance. You should expect a lot of questions from a good advisor. It's going to sound like they're being very nosy in your business, but they can't help you unless they know you. So expect to have some questions. Again, once you get to the online world, of course, you miss that little bit of human touch that you might obviously get with a face-to-face person. And finally, just investment clubs. I mean, I'm not really that familiar with investment clubs. All right, they're just groups of people. They want to invest. They pool their knowledge and money, and they manage these portfolios. Some of them can be very large. But again, they say basically there's over 200,000 individual investors in the better investing community itself, and there's about 16,000 investment clubs. So there's lots of them. I'm not familiar with, in general, their overall performance or understand exactly how you get involved with an investment club. So that's the end of the video on investment information and securities transactions.